Thank you for taking the time to come and hear this webinar. I hope in the next up to 1 hour, I will share some insights about how we're managing your money. Before I begin, I'd like to say that for those of you who are logging in from inside Israel, I hope the second quarter, particularly those two very interesting weeks in June, passed without incident. I am aware of one client who lost an apartment in Tel Aviv, but I do hope that everyone else on this call was unaffected. For those of you logging into this Zoom from outside of Israel, I think it just needs to be said that whilst Israel's projecting a message of some sort of success, it's been a very, very challenging time here in Israel, particularly those 2 weeks. And from a pioneer perspective, you know, every company has a disaster recovery plan. But we looked at our disaster recovery plan with the point of view that a missile hitting the office one night, would we be able to carry on managing your money the next morning? And we looked at it down to the granular, most detailed level of, for example, where you put certain tokens that you need to log into certain banks. So when I went running down to the bomb shelter, I literally had a box of tokens to make sure that we can carry on managing your money even without an office. Okay, the last time we hosted, remember we do one in English and one in Hebrew. The last time we hosted a webinar was right in the thick of the tariff tantrum of the first week of April. So President Trump announced the tariffs, I think it was Wednesday the 2nd. Market tanked on the Wednesday, tanked more on the Thursday, tanked more on the Friday, went down more on the Monday, and we hosted the webinar. I think it was either the Tuesday or the Wednesday night. What we did in the portfolios on that Monday, for all clients who we were able to, where there were no restrictions or whatever, which was most clients, we bought approximately 2% of the S&P. And on that 2% till today, the recovery has been about 25%. So that's about 0.5% portfolio return for most clients. So we're very proud of that. But I think the main message there is you need to risk manage your asset allocation before crisis. When a crisis comes, one never knows the reason for it, but that's the wrong time to sell. If you're going to do anything in a crisis, it's time to buy, not sell, regardless of the reasons. So we believed very strongly, and we said it very clearly, that there will be a recovery. We didn't know how quick it would be. We didn't think it would be as quick as it has been, and I'll talk about that in a second. But and we also said that fundamentally Trump is committed to tariffs. So even though when he launched the tariffs, he had the basic 10% tariff across the board, and then another per country number much greater than 10%, which really surprised the market and feared the market. And that was the base tariff, but I'll show you the numbers now. Fundamentally, he has not backed away from tariffs. So we have to question all the narratives that were existing at the beginning of April. At the beginning of April, people were saying there's going to be a recession, maybe. There's so much uncertainty, maybe. There's businesses don't know where to invest money, and all these things. And by now, that economic data is not available to either invalidate or validate what was said in April, but the market is fully recovered. So I think that that's worth looking at. Anyway, moving on. Let's have a look at how the indices have done year to date till the end of June. The first column here is up until June. The second column I just copied straight over from my previous webinar, which was up until the 8th of April. Normally we do quarter end, but in this case, we changed it till April because that was kind of like the bottom of that crisis. We didn't know it at the time. But you can see how significant the recovery has been in the second quarter. So from minus 15% to plus 5% on the S&P 500, NASDAQ minus 18 to plus 8. An interesting point about the S&P 500 is the impact of the mega cap 7. The mega cap 7 are the Google, Facebook, Microsoft, etc. And historically, what we've seen over the last 4 years is that the mega cap 7 have contributed disproportionately to the performance of the S&P. So they're approximately 30-something% of the S&P 500, but they've been responsible for about 60% of the performance of the S&P over the last few years. In 2025, some of those mega caps were actually negative, specifically Tesla and Apple. And their contribution has been much less. So they're 30-something% of the index, but their contribution to performance was only about less than 20%. So of the 5.5 that you see here, approximately 1% is coming from the mega cap 7, which is a healthier sort of ratio compared to what we've had in the past. The market is still trading narrow. So that's a technical definition, which means if there's 500 companies in the index, the performance is coming from a relatively few. So say 50 or 80. 50 or 80 companies are contributing most of the performance. So it's still technically defined as a narrow market, healthier than it has been over the last few years, but still it's a sign of potential more volatility. When only a few of your companies are contributing to performance, then it means that the success is not broad across the market. Another big and interesting thing, and something we see very, very rarely, is the MSCI World outperforming the USA. We hardly ever see it that way. So here we've got MSCI World at plus 10% and the S&P 500 at plus 5. Almost always it's the other way around. And this year, there's two reasons for it. One, developed economies, non-USA, did better than the S&P, particularly in Q1, less so in Q2, but particularly in Q1. And there's also a big currency impact. One of the stories of 2025 is the dollar has lost about 10% of its value on average. I'll talk about it in a bit more detail. So that differential between the 5.5 and the 10 is coming from two aspects. The MSCI World is approximately 60% dollars. Of the other 40% non-dollar, when you report that in dollars, there's a currency gain as well. So we see the global equities outperforming the S&P because of those two reasons. Interestingly, the Tel Aviv Stock Exchange is one of the strongest stock exchanges in the world. I think that only South Korea, I believe, did better than the Tel Aviv, and only marginally. So incredible that under the circumstances and under the uncertainty that we've been under in Israel, to see the Tel Aviv Stock Exchange perform so well. So plus 24% year to date, outperforms almost everybody. S&P, Germany's DAX, Eurostock 600, you name it. Okay. MSCI China also had a strong second quarter, but on a 3-year basis, way behind the S&P and the MSCI. That's over here. Bonds are doing their job. We've made on the index 4%. Most of that's coupon. There's a little bit of capital gain because interest rates came down just a little bit. Most of that is collecting a coupon, so doing exactly what we'd expect them to do. And bonds have been a wonderful place to be if you're a very risk-averse investor this year. Treasury bonds, similar story, mostly coupon, some capital gain. Israeli corporate bonds have got a higher correlation to equities, particularly in the downside. So you don't see as strong a return year to date, but they did very nicely in Q2. So our shekel portfolios have also performed really well. Interestingly, Tesla, I've left this in from our previous presentation in April, was down 45%, is now down 21%. I still think it's overvalued even at the current prices. Okay, the long-term story of the S&P, you've seen this almost every webinar I've done. We talk about the long-term picture. All the red here is all the various crises that we've been through over the years. This goes back to 1989, and every major crisis is listed here. So when you zoom out and you look at the long-term picture, you can see that the crises along the way smooth themselves out. I just want to draw your attention to two crises. The one is the tariff tantrum number one. So at the second half of 2018, Trump took on China and tried to introduce higher tariffs. He was not successful. And then in 2025, he's introduced much higher tariffs, and the market is still has recovered just as it did in 2018. So again, Investing in equities is all about the long term. If you zoom into any of these crises, you'll see that they were pretty significant at the time, but zooming out, you get the benefit of hindsight and long-term investing. Okay, this is an interesting one, so bear with me a second. So we often think of investors as all being the same. Okay, everybody buys a stock in the hope that it'll go up. There's some sort of value play or some sort of reason for buying it. And then along comes a crisis, and that investor may or may not sell. So in April, and remember, the market doesn't move by itself. Sellers, if there are more sellers than buyers, then the market goes down. If there are more buyers than sellers, the market goes up. People forget that. And the rationale of a seller and the motivation of a seller is not all the same. We tend to think of market participants as all being the same, but they're not. Right, particularly in some sort of crisis. So in April, when there was excessive selling, they may have been motivated by, there might be short sellers. Short sellers like to capitalize on bad news, and they sell first and buy later. There might have been hedge funds with leveraged positions, and if you're leveraged and you hit a certain risk criteria, then you become a forced seller. So we've got short sellers, forced sellers, speculators, all those type of buyers who suddenly jump in on a crisis and push the market down more. Then the market recovered, okay, pretty quickly. In two and a half months, the market fully recovered. And we blamed the sell-off in April, we the collective, we, the financial industry, blamed the sell-off in April being because of the tariffs and what would be the economic impact of the tariffs, okay? The data was not available to support the recovery. Yes, there was a narrative that Trump stepped back from tariffs. I'll show you that he actually did it. He just stepped back from his ridiculous negotiating range, but he didn't step back from tariffs. So the tariffs still existed. The economic data is not there to provide confidence for those same sellers to start buying. So we have to, how did the market recover? On what basis did it recover? And I like to look at volumes, okay? And those of you who attended my December webinar, I spoke about the structure of the market. The structure of the market to me means that there's a huge amount of money that has to be put to work every month. There are ginormous pension funds all over the world, sovereign wealth funds that are collecting money from their long-term savers every month, and they have to put that money to work. So these are automatic buyers. They buy every month to a greater or lesser degree, regardless of the narrative. So the short sellers and the forced sellers came in at the beginning of April, maybe even politically motivated sellers, maybe. And then I don't buy the narrative that the recovery is because the Trump backed away from tariffs. No, I don't buy that because the data's not yet there. It's going to take a long time to see the effect of tariffs. But the confidence was restored and the buyers were there. But when we look at volumes, so this chart here, the blue bars at the bottom is your weekly volume of S&P 500, okay? And you can see it's not terribly volatile. You can see a spike here at the middle of March and a slight spiking here at the beginning of April. And the rest of the time, the end of the year, beginning of the year is the same. So these are the regular buyers. And I really believe that it's one of the reasons I get confidence about when we're facing a crisis, because I know that these automatic buyers are going to come back regardless of the narrative. And we need to be modest about what data we actually have and what is pure speculation. So sometimes by the market, takes economic data that is old or outdated. It's like reading the tea leaves, and it really doesn't, it gives a false sense of comfort about what's really happening. But I get comfort from the fact that I know every month there's going to be automatic bias. Another reason for confidence is in the last week of June, as you all know, Israel launched the war against Iran on around the 13th of June. And the following weekend, America got involved. And then the week after that, the S&P was up 3.4%, which is quite a lot in 1 week. Oil was down nearly 12%. And the volatility index, or VIX, or what's often referred to as the fear index, was down 21%. So very, very, very strong endorsement of American involvement in the Iran war. I spoke earlier about the weakening of the dollar, and this has caused a lot of clients, particularly clients with euro exposure, because you don't normally, people who live in South Africa, they're used to currency volatility. Okay, the euro dollar doesn't often break out of the type of the 10% range that it has. Okay, so that causes a lot of, whether you're European based with a dollar portfolio or a dollar based with a European portfolio, these currencies do make a difference. So when we look at dollar strength and weaknesses, we look at it against a thing called DXY. DXY is a basket of other currencies. You can never look at currency on its own. You have to look at currency relative to another currency. So when you look at the dollar, you look at this basket. The basket is 58% euro, 13% Japanese yen, 11% pound sterling, 9% Canadian dollar, et cetera, et cetera. You can see the weightings on the left here. And indeed, against this basket, the dollar has weakened approximately 10%, 10 or 11%, which is quite significant in 1 year. But if you step back and you take a longer term view at the DXY, and you will see that it's not so terrible. We're used to it. It's happened before. Currencies tend to overshoot in a particular direction and pull back, overshoot, pull back, overshoot, pull back. We see that all the time across different currencies. And here's no different. So the current level of the DXY is similar to where we were in mid-2022. And you can see the volatility that's happened since. All right. So one shouldn't panic about it. My personal view is that it's a little bit overshot in one direction. And I'm expecting the second half of this year for the dollar to recover somewhat, not fully, but somewhat. But I need to just stress, predicting currencies is extremely, extremely difficult thing to get right. And generally you're going to get it wrong. But this pattern of overshoot, pullback, overshoot, pullback, that is something that is often repeated. Okay, let's just revisit the tariff story. Trump promised 90 trade agreements in 90 days. He's not even close. When it comes to tariffs, I think all that matters is China, right? The rest is noise. China's the important one. He doubled down and tripled down and threatened higher tariffs, but in the end, he's got 10% with China, which is very significant. And in addition, through his crazy style negotiations, he's got a lot of cooperation from the Chinese on fentanyl controls. So some success there for Team Trump. Remember, the tariffs are not on everything, but there is a broad 10% China tariff. The effective tariff rate, which I'll explain what that means in my next slide, has stabilized at 14%. All right, this is what I mean by he didn't back away from tariffs. In his previous Trump term, the tariffs were 2%, okay? And so 14 over 2 is a very significant. We've had a significant increase in tariffs. We don't yet know the economic consequence of that. It's going to take a long time. The market confidence is already there. I think the surprise factor is out, but there might still be some pain, some tariff-related pain that we just haven't seen on a company level come through yet. Okay, so the 14% effective tariff rate is still lower than what was threatening at the beginning of April. That was the 20% tariffs, but nowhere near the 2% that he had in his previous term. There will be country-specific drama and closure. Last week, they closed a trade deal with Vietnam. The Vietnamese Stock Exchange responded very, very positively. And we will see more drama. Yesterday, he threatened an additional tariff against BRICS countries if they continue to try to challenge the US dollar dominance in global trade. So there will be more, but I don't think we're going to have the same market reaction that we saw in April. The narrative is that, some stabilization of tariff policy will ease financial conditions, lower inflation expectations, better growth expectations, and therefore reduce probability. That's all there, and it's true, but it's going to take time for the data to validate that. What have we learned about President Trump? don't take everything he says literally, okay? We know it, but intuitively, when the market reacted as it did, we need to just say he doesn't mean everything he says. He anchors everything out on an extreme, and even he knows, I'm sure he knows, that he's going to settle for a lot less than what he says. Here's the long-term effective tariff rate. Okay, this graph goes back to 1937. So we've got 100 years data here. Tariffs coming way, 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 way down. And this is Trump's complaint over here that this contributed to US economic damage. And here's Trump's second term on the bottom right, around about 2%. And now it has shot up to 14%. So what is effective tariff rate? The effective tariff rate is a measure of the weighted average total tariffs as a percentage of total imports. So if your total imports are 100 and your tariff on that is average tariff, weighted average tariff is 14, then 14% effective tariff rate. And that includes if you're assembling a product in the United States and one part of your product pays a 20% tariff and another part pays 10%, the effective tariff rate is supposed to take that all into account. Just like all economic data needs to be taken with a little bit of pinch of salt. All right, let's look at the US economy. We believe in the United States dominance or preeminence theme. We think the US is too far ahead, too big, too strong to really impact, and the rest of the world is not attractive. So if you know, there's that old saying, if the United States sneezes, the rest of the world catches a cold. So we'd rather be overweight USA, and our portfolios are definitely overweight USA. The growth outlook is positive, not huge, somewhere around 1.5% economic growth, which is not amazing, but it's still positive. It's not a recession. Unemployment is still very strong at 4.2% versus the long-term average of 5.7%. The tariff surprises behind us. Companies are starting to adapt. Not all the tariff will be passed on to consumers. I read a paper that said only approximately 50%. So companies have a choice. Company imports something, pays the tariff. They have a choice. They can either suffer that as an additional cost or pass it on to the consumer. And the estimates currently are that only half the tariff cost will be passed on to consumers. It's too early to say, but those are the estimates that I've read. From a valuation point of view, and I'll look at this in a bit more detail in a later slide, they're high, but nowhere near bubble territory, okay? Nowhere near a trade signal on the valuations. On the less good news, it's all about the budget deficit and the long-term debt position, okay? These are long-term consequences. I'm going to talk about that in a second. Corporate earnings are under some pressure. They're okay, but there's some pressure there, according to the report I read from Apollo. And then within the debt space, and I'll show you a slide on this as well, there's firstly, the cost of debt is very high in the US because interest rates haven't come down, and household debt, and there is increased delinquencies in the debt market. So that's a little bit of a worrying sign, not a train smash, but a little bit worrying. All right, so here's the gorilla in the room, and that is the national debt, 36.2 trillion currently. Debt to GDP is 124%. I'll show you in historical context where that is. A government like America is never going to default. They're not going to default, okay? And they're not going to pay it back. So it's all about your interest burden. How much interest can you carry? And currently it's 1.3 trillion or 3.2% of GDP. So there's a huge number, and the outlook is that number is just going to grow and grow and grow and grow, which will put future government spending under pressure. Just to get some reference, I've got some other countries here where their debt to GDP is: Japan, 250, Singapore, 157, Italy, 137, South Africa, 75. They got their own problems. France, 112, Greece, 160. Remember, Greece had its default position in 2012, UK 102, and Israel with a very strong 67%. So as long as there's economic growth and a little bit of inflation, this problem can just be deferred and deferred and deferred into future generations. And it's the interest burden which matters, okay? What does this mean for investors? Investors should have, as in my opinion, okay, as much equity as they can. When you hear the word government debt, I want you to hear inflation or future taxes. So if it's inflation, then that inflation will filter through to company profits, company profitability, and you've got better protection in equities long-term than you do in bonds. So obviously it's driven first and foremost by your risk tolerance and how much can you tolerate, but you should be at your maximum equities for your risk tolerance. That's a discussion you need to have with your relationship manager. Okay, then along comes the one big beautiful bill, or one big complex beautiful bill, as I said. Let me just summarize it for you as I have taken some headlines of various places. Anything you read about Trump, you need to actually read, on the one side, you need to read, BBC, Sky News, CNN, and you need to read a bit of Fox and Breitbart, and somewhere draw the line in the middle, because it's quite hard to get the truth. So what does this one big bill do? It makes permanent the tax breaks from Trump 1. Trump 1 had this an act called the Tax Reduction and Jobs Act of 2018, and that had a timeline. It was going to expire. Hence these two columns on the right in the graphic here. So it makes permanent those tax breaks. Americans have a much higher estate tax threshold, lower taxes across the board. There's a tax incentive for investing in factories and factory equipment. You can depreciate. If you buy a machine for your factory, you can depreciate it fully in the first year, get a full tax write-off. That's quite attractive. Small business tax relief, retiree tax relief, lower tax on tips and overtime. So your first $25,000 of tips is not taxable. On the spending side, massive resource allocation to immigration enforcement, controversial subject, but the Republicans clearly have a big strategic goal here. It increased the debt ceiling by $5 trillion, so that avoids a little bit of a government shutdown, at least for the short term. And then there's Medicaid efficiencies. I say it in inverted commas because it's controversial. And the Republicans say that anyone who deserves Medicaid and meets the criteria, they're just trying to crack down on the freeloaders. All right. So that's the high level stuff. If you look at the graphic here, the first graph summarizes the terms, and you can see the big number, the impact, I should say, the impact of the bill. The big number here is the blue, and that is the extension of the tax. That's what this is all about. Mostly extension of the tax incentives from 2018, which were in place anyway. So they would have expired had, and you know what? I think that if the Democrats had come in, I believe they would have extended these things anyway. There's a little bit of tax increase revenue. There's some savings and spending cuts of 1.7 trillion. Remember, these are trillions. And there's some increased spending of 0.2 trillion. So the net impact is an additional 2.23 trillion on government spending of this bill. It's obviously controversial. You've read about Elon Musk and his view. He wants to establish a new party. I don't think he'll be successful because if you're going to attack the American public on taxes, no one's going to vote for you. Doesn't matter what your other politics are. So Elon Musk's view is that the budget deficit must be brought under control much, much faster. I don't think he has any chance of any significant traction. Another way to present this budgetary problem, it's not new to Trump. There was a budget deficit prior to Trump, particularly a boost during the Corona years. 2024, 6.5% budget deficit. And this graph here on the left, the blue is the normal budget deficit, and then reduced by the white block, which is tariff revenue. Okay, so if tariffs should help reduce it, but not significantly. Okay, you can see that this is still extending a 6% budget deficit out into the future, which has to be financed from somewhere, and that's the big gorilla in the room I mentioned earlier. The graph on the right here is from Wikipedia. If you Google budget deficits and you want to read about it in a bit more detail, the growing light pink is the interest burden till 2033. Eventually, they're going to reach the point what the UK had right now. You have to pay your interest. That's non-negotiable. But then your other stuff that governments spend money on becomes a big fight. And in the UK, they ended up with their drama last week about social benefits and electricity for elderly people, etc. Just a few more slides on the long-term path of this government debt problem. This one's from Goldman Sachs. Here we are at the same relative levels as we were in World War II. This graph goes back to 1940. Here's the end of World War II. Remember, it's debt relative to GDP. Okay, so the amount of debt relative to the size of the economy, and we're back at World War II levels. Okay, a big spike up here in the last 15 years. And the trajectory, because constant budget deficits and growing interest bill, means that this line is highly likely. It could be worse, but it's unlikely to be better. Okay, so come 1955, the US government is at 156%. Somewhere between now and then, I think we're going to have much higher inflation. And that's why I recommend more equities. But that's really long-term investing, but I do think that that's the correct thinking. Loan delinquencies, I mentioned this earlier. So each line here is a different type of loan. This is from Apollo, this graph. Apollo are private credit specialists. We use one of their funds. They, and I think they get this from some government website, but the worrying one here is the gray, is the student loans. So there's been a massive spike in student loan delinquencies. We can only speculate the reasons for that. And an uptick here in the orange line, which is credit card debt. Now, credit card debt in America is generally smaller numbers. And unlike here in Israel, where your credit card comes off your bank account at the end of the month, and then whatever problems you have, you deal with the bank, you can roll your credit card debt in America. And that's what many people do. And they pay a very high interest rate for that. They're currently paying 21+% for credit card debt. Now, the numbers are not huge. If you have excess credit card debt, you're going to pay hundreds of dollars, not tens of thousands or thousands of dollars. And another point I want to make about the delinquencies is credit card and student loan delinquencies are not mortgage delinquencies. Mortgage delinquencies would be a much bigger problem for me than credit card delinquencies. They're smaller in dollar number. Okay. The bond market this year, relative stability. If you listen to my webinar in December, I said that we're expecting a boring year for bonds, which is exactly what you want for bonds. It was so far, it's been a relatively boring year for bonds, except for that week in April when interest rates went down to 3.9. Remember, these rates are the US Treasury 10-year, and we use that as our reference point on bond volatility. So it started the year at 4.5, went down to 3.9. It's now back at 4.28. So if we look at 4.5 to 4.28, that's well within the range of normal. It's healthy, it's fine, it's totally in line with expectations. Bonds are doing their job, okay? What's important in bonds is the spread, how much extra you get for taking credit risk. Okay, spreads are still relatively tight, but they haven't changed much year to date. Interestingly, sophisticated credit, like CLOs, which we have in our portfolios, some high yield, performed really well during the crisis. You normally expect a much higher correlation to equities than we saw. So we were quite happy with how CLOs performed, particularly CLOs performed. Most of the clients have done very, very nicely on CLOs over the last few years. And I'd like to make this point about bonds. Not everyone understands bonds, okay? A lot of investors, even on this call, don't fully get what a bond is and why is a bond safer than an equity. And I can tell you, conservative investors in the first week of April were blessing bonds with both hands. I had some very interesting conversations with some conservative investors who were not sophisticated. And we look at their portfolio and we see that they are 90% or 100% bonds. So the asset allocation matched the risk tolerance, and the crisis came and they were unaffected. Okay. So that's just a message and a lesson about managing risk before the crisis, not during. Short-term rates, not the 10-year treasury, short-term rates are expected to come down. How does this affect you? This affects how much you're going to earn on your dollar deposit. You phone the bank up now. If you ask them to quote you a 3-month rate versus a 6-month rate, the 6-month rate's going to be marginally lower. And I know this because I did it the other day, going to be marginally lower than the 3-month rate, which is interesting. So it just shows the expectation. This graph in front of you is based on futures contracts, which just shows the market view that rates are coming down. Depends which economist you follow. Some economists are saying as many as 3 reductions in rates this year. I personally believe there will only be 1, but there may be 2. So sometime towards the end of Q2, we may see short-term rates go down by 25 basis points. That would be a good sign, okay? It's not something to worry about. It's something positive. And but it does affect those investors who've got cash deposits. Need to think about what they're going to do with that cash. Also, an interesting story from April was there was these rumors going around that the Chinese are going to retaliate against Trump's tariffs by offloading US treasuries. Okay, that was talk of the town, that the Chinese are going to dump US treasuries and force rates to go higher, thereby killing the US, making them pay even more for their debt. So we wanted to look at it, and we found this research by Goldman Sachs. This shows the US securities owned by foreigners. You can see it's 31.4 trillion, and most of it is equities, 17.7, and treasuries are 7.6 trillion. Not a small number, granted, but not as big as perceived. But more importantly are these graphs. Here you see the monthly change in foreign holdings of treasury securities through to April. So that's how much trading is being done by foreigners in treasuries. And here you see who the big holders are. So firstly, Japan holds more treasuries than China, which is not commonly known. And month on month, March to April, barely any change from Japan, slight increase from UK, almost no change from China. So this is completely contrary to what was being talked about in the market. It just shows a lot of the rumors that people talk about, particularly during a crisis, are completely false. Luxembourg, which is pretty flat. Cayman Islands, that's probably all hedge funds, but pretty flat. Belgium, pretty flat. And Canada, looks like Canada sold more US treasuries than China. And that's no major surprise, but they certainly don't have the same batting power that China has. So I thought that that was interesting to show, just to counter some of these narratives that go flying around the country. Another interesting slide about US dominance, why we like the US so much, not just about economic growth, not just about innovation and exciting companies in the US, but the size of the market, okay? If you look at the bond market and the equity market in the US, it's bigger than everyone else combined, right? The next biggest is Japan, China. You combine all of these and you don't get to the US. So it just shows the size of the investment universe when you focus on the United States. Equity valuations. This is the Shiller adjusted or CAPE ratio, which is a more stable version of looking at multiples. Again, multiples are not great do not give great trading signals, but we look at multiples just to see where the market is relative to other points in time. So multiples have come down since December. So they were very high in December, and they've come down. How do multiples come down? Companies produce profit. and justify the prices. So multiples, the CAPE ratios come down. If we look at regular price earnings multiple, not the CAPE one, the S&P 500 forward PE is currently 23, which is down from about 27, 28 in December. So that's okay. The long-term average is kind of like 18. So it's still high. It's high, but nowhere near bubble territory, nowhere near trading signal territory, but still a bit high. If we look at the S&P 500 equal weight, which treats each, remember that S&P is market cap weighted, so the bigger companies take up a bigger share. And on an equal weight basis is 19, which is much closer to the long-term average of say 17 or 18. NASDAQ is a very high, it's always trading expensive. If you're worried about valuations, you would never ever buy NASDAQ and any of the technology companies on it. Right, moving over to Israel. How am I doing for time? I've got 18 more minutes. So bottom line, the economic miracle of Israel is indeed eye-opening, okay? We went into this war expecting, from an economic point of view, a lot worse than what happened. In the end, we got strong economic growth, 3.5% annualized in the first quarter. We've got a very resilient property market and very strong banking sector. We've got increased exports, mainly military. Budget deficit grew, but less than expected. Government to GDP and unemployment, even through the war, are stronger than expected and would be the envy of most developed countries around the world. And the result of all of that is a very strong shekel. This is off the Bank of Israel website. So economic growth in Q1, 3.7, inflation coming down, a little bit of a surprise there. We didn't kind of expect it, but it's very, very small. And unemployment of 2.6. These are ratios, these are numbers, economic data, which most countries would absolutely love to have. In terms of the latest war with Iran, Operation Rising Lions, the Ministry of Finance budget deficit forecast before was 4.9, which was already good. Right? Remember, the United States is hovering around 6.5. So before the war was 4.9. Fitch said 5.7. Pioneer's team said 5.9. A little bit more, a little bit too pessimistic in retrospect. And now we look at the defense spending and property damage. So defense spending through Rising Lions was about 25 to 30 billion shekels. Yes, it costs a lot to fly planes out to Iran. Property damage from those incoming missiles, these are initial estimates. This number could be significantly wrong, but it's 5 billion shekels is the current number talked about. And that means total increased budget deficit of 35 billion shekels. Israel's expected revenues from all sources is 490 billion shekels. Therefore, Operation Rising Lions is only expected to add about 1.75% to the budget deficit to approximately 6.5. So it takes us from the high fours to somewhere similar to the United States on the budget deficit, and that's in the year of a pretty significant war. So again, very, very positive. Also, given Israel's low debt level relative to the Western world, when you issue new debt and you take that money and inject it into the economy one way or another, that's going to produce economic growth. So I think long-term, the impact is positive. CDS, credit default swap. This is like insurance. When you buy a car, you have insurance in case you have an accident. CDS is insurance against the default of a loan by the government of Israel. So you can see the left-hand side leading up to October the 7th, it was around 80 basis points, shot up after October the 7th to nearly 180 basis points, stayed relatively high till the beeper incident, till in about September last year, and then got rid of Nasrallah, etc. And it recovered strongly, went up again slightly with the after the ceasefire in January, and then spiked up again when we attacked Iran, and now has come back down to 126. So we still have a risk premium in our bond market that we didn't have prior to the war, roughly 50% more, okay, but a hell of a lot better than it was. This is an interesting thing, and it's more long-term about why Israel could benefit from the Abraham Accords. Okay, cute little picture on the left here by my colleague Shmulik. There's talk, and not many people know about this, there's talk about a railway line from basically India to Haifa. Okay, it's a long-term project. Part of it shouldn't be that long-term. So at least the Haifa to Dubai leg can be relatively quick. The undersea part will be long-term, but you could deliver by ship from Mantra in Gujarat to Dubai and then take a train up to Haifa. Currently, if you're an Indian business and you need to export to Europe, you can't go north through Pakistan, Afghanistan, and all these countries. You can ship it this way through the Red Sea and the Suez Canal. Here are the Yemenites and the Houthis watching that little area over there. And it costs to get through the Suez Canal, which is pretty much close to full capacity. It costs between $300,000 and $500,000 just to use the Suez Canal, okay, which is expensive. So the ideas come up, and it's a bloody good one. And we don't know the timetable, but I think this idea has serious economic traction and shows what can happen when you get rid of Iran's threats. So that's this direct rail line from Dubai all the way to Haifa. Interestingly, Haifa port and the Mantra port in Gujarat are owned by the same company. I think it's called Adani. And they bought the Haifa port. So there's a lot of pieces here that actually could work. Bottom line, it cuts a 12-day sea journey through the Suez Canal to a 2-day train journey, much cheaper to deliver to Europe. Another long-term reason to be positive about Israel. Another aspect about the Israeli market, foreign buyers returning. This graph, the orange is bonds, the purple is stocks. You can see this period here in the middle, foreigners selling. Q1 2025, foreigners returning quite aggressively, and I think the number will be even bigger in Q2. So overseas buyers coming back to Israeli capital markets. Who trades the shekel? The top two squiggly lines are the institutional traders. This slide is from the Bank of Israel website. Most of the trading is by professionals, not by people converting. The second line here, the green line, that is Israelis converting currency, and the red line at the bottom is foreigners converting. But you can just see that the two lines, the swap contracts, which are derivatives on the shekel, are much, much higher in volume compared to guys who convert it. I've explained in previous webinars about the correlation between the S&P and the shekel. Basically, the way we see it, and again, predicting currencies is extremely difficult to do. The way we see it is the probability of a shekel dollar at 3 to 1 is much higher than 3.7 to 1. So we think that if nothing bad happens politically, and obviously it could, but if nothing bad happens politically, the shekel is going to trend stronger to 3.1. And that has some serious planning implications for a lot of people on this call. Why diversify to shekel? I think I've said all these points. Strong growing economy. Valuations are still attractive. The valuations of companies on the Tel Aviv Stock Exchange is more attractive than the S&P 500. We've got some very profitable and stable big companies here in Israel. Foreign investment is returning. The geopolitical landscape is potentially very, very promising for the future. And of course, the shekel portfolio can better match the expenses and remove currency risk for anyone living in Israel. My crystal ball for the next part of the year, we're optimistic about the Israeli market, both the short and long term. We're cautiously optimistic about the USA market, and we believe the USA will outperform the rest of the world, somehow reversing some of that gap that happened in the first part of the year. We are expecting that interest rate cuts, but we're expecting the balance of the year to be boring on bonds, and we're extending duration slightly on bonds. That means buying slightly longer bonds. Okay, so when you register for this, we got some questions. I'm a little bit limited by time, so forgive me if I run through it a bit quickly. Shouldn't one consider moving to safe investments during this uncertainty? By safe investments, I assume you mean cash or you mean bonds. I prefer bonds over cash. I don't like going in and out of the market, in and out of the market. Fixed deposit, as I say, those rates are coming down. Whatever rate you're getting today, it's going to be lower in 6 months' time. Defense industry, we can do a whole presentation on defense. It's very expensive. When Trump says NATO are going to spend 5% on defense, it doesn't mean every cent goes to defense. When you build a bridge on the way to the army base, that kind of counts as defense. So God is in the details there. The defense companies that we are watching are trading very, very, very expensive. So we're kind of looking for an entry point. What changes do you expect in our portfolio in the coming year, if any? Nothing major. There's a few things on our watch list, and we're looking for some entry points, but no major changes to the strategy. I like this question. After a few months, can anyone determine how the future will stand, or is it total guesswork? I love that question. Thank you for that. We don't try to guess the future. Guessing the future is futile, all right? But what we do know and what we do have a lot of confidence about is how different asset classes are going to behave. Your equities, we know what equities can do while you own them. They can, the volatility. We know what to expect from bonds. So think about it from an asset allocation point of view, not trying to predict the future. At no point in the history of the investment industry has anybody had any major confidence about future events. We're not trying to predict future events. We're focusing on asset classes and how they behave and trying to match that mix for a private client. That's what we try to do. That's our business. And not trying to guess the future. Is there a flaw in the USA currency? As I said, I think it's overshot in a particular weakening and some recovery. Is there a flaw? Yeah, for sure there's a flaw. It's still the strongest reserve currency in the world. So I don't know how to define it, but yes, I think there is some sort of natural flaw there. Currency, shekel dollar, I've spoken about. Brain drain affecting Israel. I have heard of a couple of people leaving. Not many, but I have heard and read about a few. And don't forget, 32,000 people have made Aliyah since the war started. How will tariffs affect Israel? Hardly. Tariffs will hardly affect Israel. If you look at the Tel Aviv 125 companies, they're hardly affected by tariffs. Is gold a safe investment? Depends how you define safe. If you define safe as by volatility, the answer is a definite no. Gold is not a safe investment from a volatility point of view. Gold, we've debated at length. Gold has approximately doubled over the last 2 years. In order for it to double again, to expect gold at $6,500, $7,000 an ounce, that's hard to imagine anytime soon. It will happen one day long into the future, but not anytime soon. So we're not, those who had gold in their portfolios, and typically you see gold because it's so volatile, you'll see gold 1 or 2% of a portfolio. If you believe in gold, you need to hold 30 or 40% of your portfolio in gold, which we can't do because it'll be way too volatile. How long can the Tel Aviv stock market keep rising? Well, hopefully forever. In principle, it can continue rising forever, just like all stock markets. It's had a strong, 24% year to date is a very strong boost. It's very hard to predict them in the short term, but long term, we are optimistic about the Tel Aviv Stock Exchange. Israeli markets are hitting a record high. However, our investments are elsewhere. What can we expect? Well, if you live abroad and you're not invested in shekel, so then that's a discussion you need to have with your relationship manager on how to get access to Israel. If you live in Israel and you don't have shekel in your portfolio, then that's a planning problem. And I think if you live in Israel and your expenses are in shekel, then you definitely need a certain percentage of your wealth in shekel investments. Okay, let me just see if any questions came in on the Q&A. Yeah, hold on, there's one. What is my forecast against the shekel, USD, GBP, and euro? So against the dollar, I'm expecting it to strengthen. Against the sterling as well. Again, we might see the low fours, and the euro less so, but definitely the trend is stronger. But again, please take that with a pinch of salt, because predicting currencies is really, really, really a problem. It's very hard to do. I prefer to approach currency on a strategic basis. What percent of the wealth of the client's wealth is in dollars? What's in shekels? What's in each currency? Because you can't really plan it. You can't really act or react to currency movements. You need to plan it strategically. Still dismissing Europe is the last question that's just come in. To an extent, yes. To an extent, yes. If you go purely on economic growth, the economic growth prospects in Europe are poor, certainly less than the US. There are structural problems in the Europe that bother me. There are some good companies. So our allocation is low, mainly via global indices, and yeah, we still believe that Europe's for holidays is pretty much the view of my team. Okay, thank you all, everybody. I hope you've enjoyed. I'm gonna sign off now, and stay safe. And we look forward to better days ahead in Israel, and obviously with all the hostages home and all the soldiers home. Thank you very, very much for the time.